So one of the biggest things we normally look at is the payroll to revenue ratio, which is really important. I think for most SaaS companies, depending on how much, if they're doing any kind of software or if they're doing any kind of hardware, it might fluctuate a little bit. But if they're specifically services and recurring services, we want that goal of payroll to revenue to be close to 30%, because that leaves enough, and that includes the founder's salary, because that leaves enough for everything else that you need to spend money on. It leaves enough for profit, it leaves enough for paying taxes, and for having enough money to reinvest back into the business and to have 3 to 6 months worth of cash in the bank.
Are you a scaling SaaS founder? Ready to make the leap from leading a team to leading an organization? Join us each week as we refill your think tank with actionable tips and strategies from great business minds you know and those you don't know yet. This is SaaS Fuel with your host, 5-time entrepreneur, SaaS founder, and globetrotting adventurer, Jeff Maines.
Welcome back to the SaaS Fuel podcast, where cash flow control isn't about pinching pennies. It's about powering smart growth without surprise detours to Panic Town. I'm your host, Jeff Maines. Help B2B SaaS founders like you grow from traction to scale. Here, growth is more than just numbers. It's about crafting a future-proof company, premium valuation, and leaders who build a business of significance while living epic, adventurous lives. What's more dangerous to your startup, losing revenue or ignoring numbers in the trend when it happens? Too often, founders treat financials like a dentist appointment, something to put off until the pain is too big to ignore. But in this episode, we flip that thinking on its head. Financial literacy isn't just about spreadsheets, it's about clarity, confidence, and making decisions that protect your runway before it's gone. We dive into the psychology of financial leadership, exploring how changing your mindset can turn fear into action. You'll hear a compelling case study of a founder who made fast, informed decisions during a revenue freefall and walked away not just intact, but debt free. Amazing story. From understanding metrics like CAC and LTV to knowing when to bring in help, like a fractional CFO who can provide tailored insights. You'll get a crash course in turning financial stress into strategic power. And it's not all math. This episode also leans into the emotional grit it takes to lead a business through uncertainty. If you're ready to stop flinching at your financial dashboard and start using it as a tool for resilience, growth, and smart decision making, this one is all for you. Let's dive in. Our founder on Tuesday was Laura Bell-Main, CEO of SafeStack and author of Security for Everyone. Laura showed us why secure software starts with team culture. From building trust and visibility into dev cycles to preparing your startup for enterprise clients with real compliance muscle, Laura delivered a no-fluff framework for embedding security without slowing down product velocity. And our expert guest last week, 1 week ago, was Chris Daly. He is founder of Smart CRO. Chris unpacked the neuroscience behind website conversion. Forget gimmicks and guesswork. Chris shared why testing is the holy grail of CRO and how removing content is often more powerful than adding it, and why AI still needs a human brain to truly optimize user experience. If you missed either of those episodes, go back and check them out. My guest today is Natalia Zacharin, founder of Zacharin Consulting. Natalia is on a mission to simplify financial decision making for founders and help business owners stop guessing and start growing. She shares a compelling case study of a founder who navigated a massive drop in revenue without going into debt thanks to decisive action and financial visibility. Natalia offers an unfiltered look at how smart finance can unlock scale, sanity, and sustainability. If you're tired of flying blind with your numbers or making gut decisions that leave you second guessing, this conversation will give you both insight and relief. Welcome, Natalia Zachary. Hey, Natalia, welcome to SaaS Fuel.
Thank you for having me. I'm excited to be here.
Me too. You started your career in accounting, but built Zacharin Consulting to offer strategic CFO services, which is way cool. What inspired you to go beyond the numbers and take on a more transformative role with your clients?
It actually began because I was conducting all of the sales calls in the beginning, and that really gave me a lot of insight into what people were looking for. So when I would ask discovery call questions, what they were looking for, what challenges they're having, what do they do to evaluate their company, evaluate their profitability, and the answer was consistent that they didn't know. So a lot of folks either, if they know how to read the financials, they don't understand how to create actionable steps in order to make their goals. And I would actually venture to say that a lot of people don't even know how to read their financials, and that's okay because there are people out there to help.
That's true. And financial literacy is something that I think everybody should develop, at least to some extent.
Yes.
Why do you think that founders have to own their numbers, even if they don't love spreadsheets, even if that's not their thing?
I think it's really important because it is the only place that's an unemotional data center of what's happening in your business. Because we as human beings have a lot of emotion and feelings behind everything that we decide and that we do. A lot of us call it intuition, but the numbers might tell a different story. And what I found is that folks sometimes see, oh, I have a lot of money in the bank, so I must be doing really well. But if you don't understand the trends or how that happened or what is coming down the pike, you might actually be really surprised. So understanding your financials, at least at a very basic level, is very important. And it really gives you the information that you're looking for and answers almost every question you could possibly be asking.
Yeah. I think it's really interesting you said really understand why that happened. Yeah, a lot of us, I think we look at the bank account and there's a lot less than we thought, but that would be a good surprise. You look and there's a whole lot more. But either way, understanding the why behind that, I think is absolutely key. How do you help your clients do that and really understand that and then plan for the future?
Yeah, so we go pretty deep with our CFO, our fractional CFO clients, where we create projections, forecasts. Sometimes if they need a budget, we create that as well. And then we create graphs and other pictorials so that it really tells a story behind what's happening in your business. The projections are really important because we can see where are you now and where you are headed. So if you're headed in finance, it's always the trend. So if you're headed in the wrong direction, you're going to obviously get into trouble. And this gives you an opportunity to have a little insight into your business 3 to 6 months or maybe even further down the line. So you have time to make some micro corrections before something happens. Just depending on your bank account or not understanding the why of what is happening is really not enough.
Absolutely. For those that don't necessarily know, what is a fractional CFO and how is that different from a traditional bookkeeper or accountant? They may say, I've got that. What do I need a fractional CFO for?
So this is actually a really great question. The way I like to look at it is a bookkeeper is looking at your past history. So by the time they're done with adding all the transactions, and we do bookkeeping also, so we're very familiar with this process as well. But by the time they do all the transactions, they reconcile the accounts, they send you the financials. Even if they're super fast, you're getting your financials at the earliest the first week of the next month because we have to wait for everything to clear. So it's giving you a historical view. And that historical view answers a lot of questions also. And that's what we base everything on. But a fractional CFO is actually more of a visionary type of role, and it looks into the future. So bookkeeper, I would say, is past history or more recent history, and fractional CFO is future looking. Like, what goals do you have? Do you need to improve profit? How much cash in the bank do you need? Are you planning on any projects? When do you need to hire? Who do you need to hire? What does that look like? How much will that cost?
It's super, super valuable. I think all of us will look at financial statements, and I used to think that was it. I really understand how are we doing, but you can't change the past. And it's a point in time of how are you doing, but it doesn't really tell you anything about the future, how you're trending, or what you should be doing now to make sure the next time you're looking at your financials, they're moving in a direction that's positive.
Yes. I actually read something really interesting that I hadn't even thought of until I read this. So when a business is starting out, we take a lot more risks, and that's how we get to build our business pretty quickly or pretty well in the beginning. Once you're established at over $1 million, $2 million, $5 million, where, even 10 million, we tend to not take as many risks because now we're playing with other people's futures, all of our employees and our clients. So founders tend to take less risk. And actually, you should not necessarily take less risk. you should take more calculated risks, but not less. And having
Yeah.
a fractional CFO or having projections and understanding trends allows you to make those educated decisions so that you can keep growing. Because a lot of people will start around 2 to 3 million, and the growth will stagnate a little bit or be a lot slower because they're
Yeah.
taking less calculated risk.
I think that's a really good kind of delineation between the two. I mean, one is risk. And early on, when you start a business, it's, I think, sometimes all risk
Yes.
and you're all in, but every decision can't be that. But you're right, we start to pull back, especially as the business starts to grow, because we don't want to lose what we built. And so those things that made us successful, we stop doing. And having somebody that can really, the calculated risk, taking that's such an important word in that you're not just pulling back and not taking risk, but you're following the smart money. Where can I put resources and take risk where there's a really likely return on that investment?
Yes, and how to calculate that return and figure out
Yeah.
if you're getting it.
And not just making it up or guessing.
Yeah,
I feel like if I put another 10,000 a month in marketing, we're going to get more sales.
not necessarily, but yes, exactly.
Right, right.
That is the feeling. Or I feel like if I just add a lot more salespeople, we should get a lot more revenue.
Of course.
Yeah, there's a lot more data that goes with that to see if it's actually successful.
Yeah. Yeah, a lot less guessing, a lot more calculation. And I think that fractional CFO is absolutely key in that.
Yes,
If it-
for for a very small price, because it's a fractional title, instead of paying someone, so if CFO would cost about 250,000 at least to
Mhm.
hire plus benefits at a full-time level. And most companies, I would even venture to say 20 million and under, probably don't need a full-time CFO yet. And
True.
they can get away with having a fractional CFO. So that person is there when you need them. You still have your monthly cadence. They understand your business. They have the opportunity to see patterns between other businesses, which is really key. Because if you're working for one company for decades, you don't really see patterns. You
Right.
patterns in the economy, but not in different businesses and what's working for different people. So I think the fractional type of employment and the contractor is really a great answer to a lot of for companies going forward.
You're so right. And absolutely with the revenue. Yeah, if you're 5, 10 million, 20 million, maybe it starts to make some sense if you have a more complex business to bring in somebody full time. But you can go fractional a long way.
Yeah.
What revenue or complexity or maybe decision or what triggers making that necessary to bring in somebody fractional? Should you do it from the beginning, or is there an event where you go, hey, from this point forward, I need to do this?
I think it really depends on the founder and on the business. It depends on growth. So some folks might, so for instance, if you're a startup and you're really planning on hitting that 500,000 to $1 million point in revenue in a couple of years, it probably makes sense to hire someone quickly, because then you can really see if what you're doing is working and you have a partner, a strategic partner that you can bounce ideas off of. Usually we see folks that are about at a 500,000 to $1 million at a minimum that are more interested in hiring someone. And our sweet spot is probably from 2 to 10 million. And then after that, it's still a sweet spot. And we have clients up to 35 million right now that are still clients. But that's when we start recommending that you should probably start considering a full-time in-house person.
That makes sense.
Yeah.
When you walk into a business, what is the first thing you usually fix or improve?
One of the biggest things that I see that most businesses do is spend a lot of money on their payroll. So your human
Yeah,
resources is going to be your most expensive resource. You want to attract really good people. You want to give benefits. You want to give good salaries. And I totally agree with all of that. But you have to make sure that they're efficient and that your revenue can sustain that. So one of the biggest things we normally look at is the payroll to revenue ratio, which is really important. I think for most SaaS companies, depending on how much, if they're doing any kind of software or if they're doing any kind of hardware, it might fluctuate a little bit. But if they're specifically services and recurring services, we want that goal of payroll to revenue to be close to 30%, because that leaves enough, and that includes the founder's salary, because that leaves enough for everything else that you need to spend money on. it leaves enough for profit, it leaves enough for paying taxes, and for having enough money to reinvest back into the business and to have 3 to 6 months worth of cash in the bank for any given time. So that's what we're trying to look at. And that's the first thing that usually we can make the biggest impact on. And it doesn't necessarily mean that you have to let people go, but it means that you start looking into and digging in, are people being efficient? Are they effective in their roles? Are they the right fit in the right seat? And are you charging appropriately? And do you have enough clients? Maybe you need to get more clients, which is usually the case.
Right. Yeah, especially early on because the revenue grows and you add people and it's probably out of balance
Yes.
at some point, and then you want to grow into that and not just continue to hire like crazy.
And people tend to hire when they feel like they need someone rather than to hire when the numbers say they need someone. And so that's
Oh,
always,
that's good.
yeah, that's always an indication that something's wrong, right? That either the pricing's wrong, maybe the service delivery isn't as efficient, maybe the package that you have, the different services that you're packaging is somehow could be tweaked and be a little bit better. Or maybe you're hiring people that aren't at the correct experience level that you need them to be. So there could be a lot of little tweaks there. And that's what we find a lot of the times.
I think you're right. And a lot of times looking for maybe lower level or what can I afford instead of what do I really need. And
Yes.
so maybe spending too much on people that don't have the right skill set just because you don't want to spend more on a particular person
Yes.
or
You know,
role.
that reminds me of my own experience. So my first hire was someone that was a lower level that I took the time to train. And I was nervous about hiring someone at a higher level, a manager, because I didn't have any other people for them to manage. But honestly, they would have taken a lot more off my plate. And usually the founder is also driving the business development. It's not really who you're hiring. It's not really how you're going to do things. It's who's going to do those things. So the founder can keep building the business and looking forward. And it would have made a lot more sense for me at that time to hire a manager. I was just too scared to do, but it would have taken a lot more off my plate. And it took me 2 years to figure that out that I can't get back.
That's one of the most precious resources we have is time. And so figuring out how we allocate that and not worry so much about a few dollars here or there.
Yes.
Yeah. You brought up a great point. So let's talk forecasting. Most SaaS founders are great at selling, but weak at planning. And I would say that I probably fall into that category. Not probably, but I do. What is your simple framework for building a useful forecast?
First of all, the accounting needs to be really accurate and done well. So we check on that. Then we actually change the chart of accounts to make sense and we regroup things. So a lot of bookkeepers don't really know how to read financials and they don't know what gives the most clarity to the founder. And a lot of tax specialists, the tax preparers, they need to see certain things, but there's a lot of wiggle room still for what we can show the founder. So for instance, we will consolidate a lot of things that are unimportant on the P&L, so that makes it easier. And then we will break things out in different channels. So for instance, advertising, marketing, if you're increasing your online spending and I don't know, Facebook ads or Google ads, you want to see that because you want to see how it affects the top line. You want to break that out. So first of all, we create a structure and then we create out of that, we pull that information out. And I love Excel. We are very high technical. We use a lot of software. We're a fully virtual remote firm, always have been, use everything cloud-based. However, I still love Excel for forecasts because it's the most malleable and we can
Sure.
really customize the metrics and really break things out or break things down into percentages and goals. And so that's how we start building it out, is just taking the profit and loss for the last several months, seeing what the trend has been, understanding the metrics and the KPIs of where the business wants to be or needs to be, and then slowly building that out from month to month on little things that need to change, because it's always little tweaks. It's never really a big thing that makes the biggest change. It could be, like if you're spending like, I don't know, $10,000 in marketing that isn't working for you, it's not working for you. So you should probably stop spending it on that marketing and change gears. So that would be like a big thing, but it's usually the little tweaks that really help. And that makes it the easiest to make little changes over time and they make a big impact within a few months.
Yeah. You use the big M word, metrics.
Yes.
What metrics matter most when you're trying to scale a SaaS business profitably?
Yes. So first, I would say, what are your revenue goals? And I'm a big proponent of there's no reason why you shouldn't be doubling year over year, probably until you could probably double until you're about, I don't know, 4 or 5 million, maybe even up to 8. So doubling 8 million is really hard, but you can still grow 4 million in a year. And I wouldn't say that's impossible. So I think a lot of folks, first of all, think that they shouldn't grow as quickly. It could be chaotic, but if you put in processes and systems into place, it's very possible. And I know this from personal experience because we've been doubling and tripling every year. That's very possible. So the first thing we look at is, what is your goal? And is your goal attainable? And is your goal, or is it too light? If you're at 1.2 million and you're like, oh, I want to make 1.5 this year, that's probably not good enough. You can definitely grow faster. There's a huge need for what the SaaS industry does. And there's plenty of market in the marketplace. So there's plenty of ways to sell that business, to sell those services. So we look at revenue first, and then we plot out, what do we need the profit to look like? What do we need the payroll to look like? Who is going to be in those seats? Who is actually working for the business? So those are some of the metrics we look at. We look at the metrics cash in the bank. It's a huge metric, and that is very different than profit. So profit does not always reflect the cash. And that's because if you have any kind of loans or owner distributions, or maybe you have several businesses and you're moving money to other businesses, none of that's going to show up in your profit, but that is money that's moving in and out of your business. So we want to look at cash. What other metrics do we look at? Oh, if you're doing any kind of marketing or sales. So we want to see if there's a way that we can create some kind of predictability in your revenue, in new revenue. So if you're, for instance, a managed service provider, and that is a monthly recurring revenue, what is your average revenue? What kind of clients do you go after? How many leads are you getting? How many of those leads turn into sales calls? What percentage of those sales calls become clients? How many show up? How many become clients? Those are all percentages. And if we have an average monthly revenue, we can actually plot out how many clients you need to close every month to get to your goal. So it's cool. And then you look at the projections, you look at the actuals and the variances, and that's a conversation of what's working, what's not working, and why.
I think that's really interesting. You pointed out the difference between cash in the bank and profit. And I've heard multiple stories of a founder looking and get their financials from their bookkeeper or accountant, and they're like, it says I have a profit, but I have no money in the bank. If I've got a profit, where is it?
That happens all the time. Some of the smartest people I know still don't understand it. And that's totally fine because it's accounting and it's not really for the faint of heart. Like, you guys are out there doing your thing. I can't do IT and managed services and cybersecurity. Like, I have no idea. That would be a disaster. So I totally get it when others don't understand the difference between profit and cash in the bank. We have a case study where it was a couple of brothers that owned a company, and a lot of money would come in. The majority would go right back out in cost of goods sold. It was a big logistics business. But we were talking big numbers, like 25 million in revenue. Wow. They were at a negative 800,000 in profit when we first started working with them, and they never had any cash. So they were like, what happened to all the cash? And what was happening was, because all this cash was coming in, and these were really smart people, they were taking the cash out of the business and buying real estate to buy up a portfolio for retirement, passive income, and all the things that everybody wants to do, but not taking into consideration that the business actually needed that cash at the time. So they never had enough cash, and then their profit also wasn't where it needed to be. So by the time they came to work with us, they were really concerned. They had talked to another consultant who said, just close your doors, you're done for. And in 6 months, we worked with them. We turned it around to having a lot more cash in the bank and a positive 200,000 in profit within 6 months. So that's $1 million in net difference. Wow. But that's what happens, is that folks just tend to pull money out of their business. Maybe they have a lot of personal expenses. Maybe they're investing in other businesses and other ventures. Maybe they're buying, another one is buying a lot of equipment, trucks, a lot of things that have loans. So a lot of those principal payments will be cash that's not showing up on your profit. So that's just cash going out the door that you might not be aware of.
Ready to dominate your market and skyrocket your revenue? Dive into Small Fish Big Pond, delivering a world class business that swims circles around competitors. This book is packed with powerful marketing and leadership insights guaranteed to transform your business and operate world class. Small Fish Big Pond delivers proven strategies to sharpen your marketing message, deliver unmatched value to your clients, and guide your prospects' buying journey to one inevitable conclusion: that your company is the only solution for them. Inside, you'll find step by step frameworks and time tested growth principles to attract your ideal clients, convert them, and then turn them into your passionate brand ambassadors. Grab your copy today in print, ebook, or audio at smallfishbigpond.com or on Amazon. Plus, remember, every book sale supports charity. All profits go there. Always have, always will. So dive in and make a difference. Very similar scenario happens in SaaSlandia, and
Uh-huh.
that is with client acquisition costs, CAC. And
Yes.
say a SaaS company, they spend, we'll just use a round number, say $5,000 to bring a new client on, and that client is worth, say, $400 a month. And hey, these numbers work out really well. And so they're putting this out there, they're acquiring, so they've got lots of customers, they're growing really fast, things are great, but they're collecting this monthly. And there's this trough in between that payback time
Mm-hmm.
of collecting that 5,000, which is going to be somewhere around 9 months, 10
Yes.
months. And so you've got this trough of all these people you brought in, and you're continuing to do that, and they can grow themselves to death by not having enough cash to make sure that they close that gap.
I would look at, first of all, how can you lower that? So if your client acquisition cost is that high, maybe you're not getting enough leads for the spend is usually, or enough people that are closing. So
Sure.
where is the problem? Let's first look at like the beginning of that timeline. The first is the spend on in the marketing or the advertising or however you're spending that money. The second is how many leads are opting in, and then how many of them are actually getting on your calendar or on your sales person's calendar, and how many are showing up. So you can see as this progresses, where is the problem? Where does it drop off? And then how many are being closed? So I would look at those things first. And then
Right.
also do a CAC to LTV ratio.
Yes.
So that's the client acquisition cost to the lifetime value of the client. So if you have clients that are your clients and for 10 to 12 months and then they drop off because of service delivery issues or some other reason and the churn is high, you're actually never really making a profit.
Yeah. And I think the average right now is somewhere between 9 and 14 months, the payback time. And
Yes,
some of a lot of the targets are like 5 to 7. Ideal is considered 12 or less, and I think way less.
yes,
And even in that scenario, figure out how to raise prices, figure out how to lower that cost, both of those, or figure out how to bridge that gap, get paid up front, for
yes.
example.
It
And
makes it a
there's a
lot,
lot of ways to do it.
yes, sorry. It makes it a lot easier to graph it out. So that's what
Yes.
we do. Because if you're just looking at it in black and white on a spreadsheet, it's not really giving you the same information. Your brain doesn't process that information the same way. But we actually graph it out so you could see where you're headed. So if your CAC keeps going up and up, we're like, uh-oh, something needs to change. Or even if it stays the same, but it never goes down, you actually want CAC to go down over time. You
Yes.
want to get better at lead generation for less money over time so that you know that when you invest even more into lead generation, you're getting even more leads.
Oh, absolutely. And these are all really helpful conversations to have, and I think probably not had nearly enough because they don't have the right expertise, like a fractional CFO, to help them think through these things.
It,
Even know that this is a potential problem. We could run out of cash in 6 months because we're growing too fast.
yes, that actually happens really often because when companies grow quickly and revenue keeps building, companies tend to spend a lot more.
Yes.
And And so spending gets out of control. They're like, they keep hiring, they keep spending more money on marketing, they keep spending more money on other software. Maybe they have to buy computers for all of their new hires. There's always something. And so it's really easy to fall into that pit of desperation where
Yeah.
suddenly one day you look up and you owe the government a lot of money because your net profit was showing that you were making a profit and you don't have any money in the bank to pay that. And
That's
what happened? Where did I go wrong?
yeah. I think founders often want to grow top line fast. That's how SaaS companies are valued. It's revenue.
Mhm.
And for whatever reason, for a long time, a lot of founders and investors too, thought
Mhm.
profit was something that didn't matter. This probably changed a little bit the last few years. Hey, fundamentals actually do matter. Making a profit's a good thing. But a lot
Yes.
of companies still don't see a lot of growth on the bottom line. And where are the typical leaks in the system where they've got great top line growth, but they've got the leaky bucket and revenue is falling out?
Well, CAC is one of them. Payroll is a big one. That's always going to be a possibility of an issue. Usually, when we're working with a new client, I would say 8 times out of 10, there's that ratio is not aligned. And so it's always the conversation of maybe we need to do an employee rinse, which sounds a little bit harsh, but it's your business and your business has to grow and your business has to be healthy. So your business comes first. And it's a matter of who are the top employees that are the most efficient. They fit in with the culture. They understand the vision and the mission. They really do their job. They're very effective and efficient. And then who are those that are not? And maybe can you move more of that work into, if you let someone go, can you move the existing work into like all the employees that you currently have? And if you can't, then maybe that's a pricing issue. You're not pricing high
Right.
enough or well enough. I find that some companies, especially if they're working with hardware and they're selling hardware as a loss leader, they really are losing a lot because they have this huge hardware cost. They're not making any money on it. And so that's really also digging into their profits. I don't know if you have listeners that do that, but I've seen that happen oftentimes, is that the services are actually profitable, but if they're also selling hardware and then they say, oh, I can't sell the hardware for more because it just won't sell, well, it doesn't make sense then to sell it at all if you're not making any money on
Yes.
it. So just don't sell it. Yeah.
I
Or
think that's a hard thing to take as a founder of,
yes,
no, this is my business model. What do you mean I should just get rid of that piece of it?
yes.
But it's true. If you're not making any money and there's no margin in it, why are we doing this?
Yeah. Why are you doing it? Or just increase the price and then see, like, then that's a sales
Right. Yeah.
issue. Really, really
Yes.
getting over those objections, right? So the sales process starts at the objection. So understanding what the objections will be, really doing a very good discovery, understanding the pain points, understanding your customer's language, your client's language, and selling the hardware at a higher level because you're selling value instead of just price. There's a lot that goes into that.
100%. What's your playbook for turning a high growth, low margin SaaS business into a sellable asset? How do we make that attractive?
There's a lot that goes into that, but honestly, I love this conversation because if you're thinking of exit strategy, you're building a healthier business. And
Yes.
one of my favorite books is actually by John Warlow called Built to Sell.
Yes.
It's a parable. It's super easy to read, and you'll be reading it and be like, oh yeah, that makes sense, duh. But normally we don't do those things. So it's a very good book to start reading. And that's actually what a fractional CFO also helps with, is how do we change everything and create the most valuable asset to sell later on in the business. And there are a couple things, right? Momentum of the revenue growth is still important. Just like we were saying before, that is what a lot of acquirers are still looking at, is revenue and the momentum of growth. Profit is still very important. The more profitable you are, the more money you're going to make, especially because you'll stand out from your competition.
Right.
So for instance, there's no reason why a service-based business shouldn't be seeing 40% profit, maybe even 50% profit. So that's something to think about. So you should be at 60 to 80% in cost of goods sold in gross profit, 60 to 80% in gross profit, and then about 40 to 60% is what you should be shooting for in profit. And I would say the majority of folks that we see are probably in the 10 to 20%. So that's one of the things that we start working on. The getting the founder, the CEO, out of the day-to-day tasks is a big one, because your business is not as valuable if it can't run without you. Because how are you going to sell the business if you have to be there?
Right.
So transitioning all of the day-to-day tasks to others is really important. Having a very strong team that's highly talented, effective, compensated, and still having a really great profit is important. Having amazing financials actually adds value to your business. If you,
Yes.
especially if you sell it, it adds value to your business on the day-to-day basis because it gives you clarity, but it adds value to selling your business. Having good financials that are tight, that are accurate, and having a streamlined, modern technology type approach to your financials, cloud-based financials, works actually better also. And let me think if there's anything else. I think those are the main points, really. The founder not really being in the day-to-day, having great financials, having processes and systems, I think would be the
Yes.
next. Yeah. Processes and systems is something that they also look at.
Absolutely. And Build Sell is a great book. John Worrell is a good friend and a fantastic book. I think one of the
Yes.
best out there for founders to read and think about, and just really frames out very well how to think about the business and what really matters to an acquirer, and see your business the way that somebody else would see it if they're looking
Yes.
at it from the outside.
We do offer valuation services as part of our CFO package. And I think that is a great starting point of what is the benchmark of your business today, so that we know what we're working on is actually making your business an even more valuable asset in the future. And what does that timeline look like? And that's really fun. Those are fun conversations to have.
Yes. What tools or systems do you recommend to founders for staying financially organized without needing to hire a huge finance team?
I think that if you're under, let's say, even definitely if you're under 5 million, you're still at a really good position to contract that out, because you're going to find someone that's a much higher level that could do the work faster
Yes.
and is less expensive than a full-time employee, especially for bookkeeping tasks. A lot of SaaS businesses have their invoicing. Usually it's subscription basis, I would say most of them. So their invoicing is really not a problem. And if you can collect money upfront, and a lot of them do already, so that's highly valuable as well. But hiring out is going to be a good idea. Once you get to over 5 million, maybe start looking for some in-house support, but looking for someone that is not at a low level, because bookkeeping is not data entry, it's true accounting. And so you need someone that really knows what they're doing.
Makes all the difference in the world.
It does.
Yeah.
I think it's made the difference for us. We've grown extremely rapidly because I have an unfair advantage of I have a sales background and I understand numbers and patterns. And I've also really believe in hiring people to help. So those folks that are like the masterminds and mentors and fractional CFOs, like all those folks that in the business consultants and coaches, they can shorten the time it takes for your growth, because they've already been through it and looked at everything and studied everything, and what's taken them years to perfect, they can relay that information to you in a much shorter period of time.
Without a doubt. And that mentorship, masterminds, that's really near and dear to my heart. It's a core piece of what we do. And you can really increase not only financial literacy, all sorts of knowledge through community.
Yes, it really, community is really important for business owners because it really normalizes not only growth and success. So, for instance, when I started working in my business and I thought, I just want to get to 250,000, that's going to be amazing. And then I joined a mastermind when I was at about 300,000 in gross revenue. And I was the smallest business. I joined the executive level because I really wanted to grow. And so
Yeah.
that normalized numbers that were like 1 million, 5 million, 10 million. So now even talking about a $40 million annual revenue for me seems very normal. And it also normalizes failure, because being a business owner is very tough, and having a community around you that understands that is really important.
Really is. And I love what you said just about that and taking that step and getting in there. And you were the smallest company. We talked about this before. And just for other companies and just be around to see what's possible. And for them to be talking about their numbers and they may be at 5 or 10, and you're like, you can do that? And they're like, sure. Here's how we did it. And they
Yeah.
give you the playbook and you're like, wow, this is amazing. It expands your mind. And a mind once stretched can never return to its original shape.
Yes, it's been a fascinating journey. I can't say that I'm the smartest on the planet, that I figured it out all on my own. I'm just very smart about hiring people, reading a lot of books, and looking at
Yeah.
numbers. But it's been an amazing journey. For us as founders, it's really important to have friends in that space and people that you can bounce ideas off of. And I
Yeah.
find that even with the fractional CFO, just like with any kind of mentorship or mastermind, it's not just numbers, it's mindset. And half the time it's almost like therapy or bouncing ideas or taking the emotion out of a decision that makes it so valuable. Is really just the trust really builds, and it's someone that supports you in all the places that you need support in. And honestly, like, it's a roller coaster to be a founder, so you need all the support.
Absolutely. Yeah, I really appreciate that perspective. That's huge. AI is starting to influence bookkeeping and tax. I think it's influencing pretty much everything. How
Yeah.
should founders prepare for that shift? And where will humans still be essential 2 or 3 years from now?
So I think AI is still far from being perfected in bookkeeping, even though some accounting type software companies will tell you otherwise. What they're doing is
Some have tried.
and some have tried. Bench accounting tried and almost went out of business, and then they
Yeah,
got bought overnight by another company. What they were doing on the side was, first of all, they blew through I think it was $360 million. I can't remember what it
a
was.
lot.
It was a
Yeah.
lot. They blew through millions and millions of dollars, hundreds of millions of dollars. And the AI is not good yet. So what they were doing was they were hiring people in the background from other countries to actually do the work because the work wasn't getting done correctly. So AI is
So intelligence, not really artificial intelligence.
not really artificial, not yet. It's getting closer, and it's really taking out a lot of the automated, the tasks that are recurrent, right? So the boring, recurring kind of stuff. So you can create rules, and you still have to keep an eye on everything. So it is making it easier and faster. You still need someone who knows what they're doing to keep an eye on things, because it can blow up and go in the wrong direction. I did hear that tax returns might be 100% AI and not done by people in the next 2 to 3 years, which is a little bit scary too, to think
Yeah.
that way. But the future is really coming, and it's coming fast. And it's going to be bumpy, and it's going to be interesting. And the people that are putting their head in the sand are going to be left in the cold. It's really the value driven, human based consulting that's going to always stay. And that is irreplaceable. You can
Yes.
ask Chat GPT for all the things, but having a conversation with a human being that can ask you different questions because it sparks another question from some of the answers you gave them is something that no one can replicate at this point.
And having somebody like you that sees multiple companies, yeah, I think it's one thing to know one way to do something, but
Mhm.
mastery is knowing 10 different ways and being able to pick the 2 or 3 that are most likely to have the greatest benefit right now. And I see that as something that you really bring because you have that knowledge and you see so many different ways of doing things.
It's been great because we can see patterns of personalities, patterns of emotions, patterns of decision making that works, and the patterns that don't work. And it's definitely a pattern. You could take 50 different people with 50 different backgrounds, 50 different industries, different levels of success, and the patterns are still very similar. It's fascinating. I think it's really like the psychology of money and the psychology of success.
That's good. What's one mindset shift about money, that psychology of money, psychology of success, that would separate profitable founders, those that do really well, from those who are consistently stressed about cash flow?
The first one is not to be afraid or triggered by looking deeply into the numbers. because it's like saying, I don't want to go to the doctor even though I have symptoms because I don't want to know I'm sick.
I've heard that before. Yeah, the doctor's just going to tell me I'm sick. I don't want that.
Yeah.
Doesn't
So
change the facts.
doesn't change the facts, and maybe you're really not that sick and things can be changed.
Right.
So really having support system and having that basis and being able to see what's really happening and making decisions off of data rather than off of how you feel or what you think might be happening. So that's the first piece. I lost my train of thought for the second piece. What was the question again?
Mindset shift
Oh,
separates profitable founders from those constantly
yes.
stressed about cash flow.
Thank you. So first, understanding the numbers, not shying away from that. The second is founders that are making fast decisions usually win. So it's not how much money, sometimes it's the velocity of money coming in. It's not the fact that you have to terminate someone, it's how fast you terminate them that could actually make a difference. We had one of our clients that lost some of their biggest clients. They had a few mergers and they lost $50,000 a month in revenue just suddenly. And the question was, are you going to base your business on who you are today or who you will be in 6 months? Because it might take 6 months for you to repair this.
That's
And
powerful.
and he had to base his decisions on who he is today. And he made very quick decisions. He had to lay off almost his entire team, which was painful. However, he didn't go into debt. He didn't have to take these crazy loans, which I've seen other people take. I'm like,
Yeah.
are they going to come break your legs? I'm scared for you. So don't take those crazy loans and make decisions for where your business is now or where it's going to be because it's predictable. So this was a very unpredictable event. He had to get rid of most of his team. It was heartbreaking, but it was important. And as he built his revenue back up and he replaced his team, now with he has more experience, and we do also with him. He's able to replace an even better team, which has been really fascinating. And so they're actually back up to where they were. It was very tricky. It was tricky for 12 months. And this person didn't give up. So that's another mindset. Don't give up. Have the grit, make decisions that are tough and make them quick, because a fast decision is better, making a fast decision and making a mistake and then recovering that mistake quickly than not making any decision at all or making a slow
Right.
decision.
So good. The founders listening right now, maybe they feel a little overwhelmed by their numbers. What's the very first action they should take this week to get clarity?
First, I would say, who is doing your accounting and is it on time? Who's doing your bookkeeping? Is it your wife or your business manager who may not have an accounting background? So they might be doing it correctly. I'm not saying they're not, but make sure that it is correct. And sometimes the
Yeah.
only way to do that is to have someone take a look at that. So who is doing your accounting? How much experience do they have? What does that look like? Is it accurate? And is it timely? Are they getting it done on a timely basis? Because that's something that unfortunately my industry is not great at. And that's something that we are very passionate about, is to have timely financials. So I think that's a good place to start. Another place is you can always call us because we have a Calendly link that's going to be on this podcast, and we can do a free consultation and see where you're at and give you some ideas. Our goal isn't to sell you. Our goal is to let you know what we think your next steps should be. So if you decide to hire us, that's fantastic. But if you decide not to, you know what to do next.
Super helpful. Where can people learn more about you online?
So we made it very easy. It's at zacharinconsulting.com/SaaS Fuel. So it's a special page specifically for the audience. They'll recognize you, podcast, and also there's a giveaway of 7 ways to find money in your business now. And there's another giveaway of the ultimate checklist for financial success in your business. And then there's also a link to a free consultation.
That is outstanding. Huge value. And we'll make sure and link that in the show notes as well. It's easy
Yeah.
to find. Super valuable. Natalia, it's been an absolute pleasure. Thanks for being on SaaS Fuel.
Thank you for having me. And it was great. I really enjoyed chatting with you too.
Thanks again, Natalia, for coming on the show and sharing your insights and resources. You can learn more about Natalia at ZachariConsulting.com. As always, all links, resources, highlights, and full show notes are available at SaaSfuel.com. And be sure to check out our YouTube channel as well. It's at Champion Leadership. Tons of resources over there for you. Thought leaders share. Share this episode with someone you'd love to build something with. It is a great way to align on big ideas. And that is a great one right there. Everyone who shares this week gets a golden trophy that says shared a podcast, elevated the ecosystem, deserves a standing ovation. Trust me, it'll look great on your LinkedIn shelf. What if your software tools could be both open source and enterprise ready? Next up, David Young, founder of Federated Computer, joins us to talk about building privacy first distributed productivity tools that give companies control of their data and their futures. Then next up, we welcome Patricia Fripp, Hall of Fame speaker and master of persuasive communication, who has coached Fortune 500 execs and rising founders alike to deliver presentations that engage and convert. I will see you next time, and as always, enjoy the journey.
Thanks for listening to SaaS Fuel. Full show notes for each episode, which includes a summary, key takeaways, quotes, and any resources mentioned, are available at saasfuel.com. Be sure to follow and subscribe wherever you listen to podcasts. And if you're enjoying the content and getting value from these episodes, please leave us a rating and review at ratethispodcast.com/SaaSfuel. We'll be sure to read these out on future episodes.